moving into our third segment out of this exam 2 material. We're still going to use and focus on variable costs, fixed costs, and of course our contribution margin. But we're going to kind of move past the break-even, margin of safety type issues we've looked at the last 2 weeks. Now we're going to look at more of making decisions from a business standpoint. What we're going to be focusing on here, one of the terms here is incremental analysis, the changes that can happen under different alternatives. These are the 5 things we're going to focus on here. And we're going to look at each one of these in particular as we move down. So we're going to look at accepting a large order at a special price. Think of this as companies selling the off-brand, like the Kroger brand or the Walmart brand. So the big companies, the General Electric or the medicine companies, maybe Tyson Foods, they're going to work with these knockoff brands and selling basically the same product, but just at a special low price. And we're going to see how they can still make money doing that. All right, should the company make or buy their products? If they have room, can they make the products and save money instead of buying it? Or is buying it the better option because it costs them more to make it based on having extra people around and having to pay them and extra machines? Selling the products or processing them further, do you want to sell just pieces of the product, or do you want to sell the completely assembled finished product? Which one is more profitable? Number 4, this one, you can use this in everyday life, especially when you're looking at buying a big purchase like maybe a new car. Do you want to continue to repair your car, or is it best to simply scrap the old car and replace it? Finally, when a segment of a company isn't doing very well, the first instinct is to get rid of that segment. That may not always be the best bet, and we're going to see that when we focus on the fixed costs that may or may not be eliminated by getting rid of a special segment. And then, as you'll see, we're going to mainly look at dollar values to see if something should be done or not, but there are always things to look at that are non-dollar based. So we can't just do that when you actually have your own business. You got to look at, how does it affect the community at large? Will it have a negative impact on your perception, on the public's perception of you? How does it affect your employees? That's going to be important. All right, some 3 big terms that we need to know and understand for this week's material. First one here is relevant cost. These are the costs that actually are going to change and have a difference on a decision making. For example, if you were making a trip and you were either going to go to Louisville or continue down to Nashville, well, let's assume you had to go through Louisville to get to Nashville. The costs from your home down to Louisville would be an irrelevant cost. Those costs are going to be there no matter which option you choose. The relevant cost would be staying in Louisville, which would be 0 extra miles in gas, or the additional miles in gas to go on down to Nashville. That would be the relevant cost there. Opportunity costs. Now this one, it's kind of like an oxymoron. They're a contradiction. Opportunity, you think, ooh, something I'm getting, but then a cost is something I'm losing. So that's why this term can be a little confusing. But basically, think of this as, what are you giving up? What opportunity are you giving up by choosing an alternative? So here I gave us some. So what opportunity are you wasting? What lost opportunity? Here's a couple of ideas to think about. When you are 18, graduate high school, you're going to have a decision to make. And the alternative to whatever decision you make is your opportunity cost, something that you're giving up. And in this case here, what I have is you attend college full-time. That was your decision. So your opportunity cost, what you're giving up, is making money right now by working. Whereas if you went the other way and you decided to work right after school at a full-time position, you're giving up your opportunity cost is the potential to have a nicer, perhaps better paying job in the future. So that's the opportunity cost. We're going to be using that later. And then finally, the last thing we need to understand is what a sunk cost is. And these sunk costs are costs that are already expended. We can't get them back, and therefore they should not have a bearing on our future decisions. And I give us a couple examples. We already spent $5,000 for an appraisal, maybe to buy a new house. Well, if you were thinking about it from a non-sunk cost type of mindset, you would think, I've already spent that much money. I don't want to lose it. So therefore, it's best for me just to go ahead and buy the item because I spent that money. Well, maybe, maybe not. And what if in a year you don't like that item anymore? Now, not only did you lose the $5,000, you just lost $50,000 or $100,000 extra dollars because you let that $5,000 play with you and make, in fact, impact your decision. Spending money on repairs like your car, thinking I just put in a new air conditioner, maybe I can just make my car last a couple of years longer so I can get the money out of that. But then 2 months later, something else breaks down, and something else breaks down 2 months later after that. Maybe that initial $1,500 shouldn't have played into your decision. Here's a couple of few everyday life situations that I came up with sunk costs. If you were in a bad movie, think about what you would do. If you just spent $10 to go see a movie, and after the first half hour you didn't like it, would you get up and leave, or would you sit there and be mad the whole time, but just to get your money's worth? That initial money that you spent is a sunk cost. What about something that you could do in this class with your project? You've been working several hours on the project, but then you've decided, yeah, this isn't a very good project. Are you going to keep in mind those initial 3, 4, 5 hours that you spent and just purge and just keep going with the original project, even though it's not so good, so you don't waste those 3 hours? Or do you just start over and hopefully get a better grade with a new project, knowing that those 3 hours are going to be wasted? I thought it was important here that the economic profession, and you could put accountants into this pretty much as well, that those in the economic profession are most likely to weigh the cost benefit outside the classroom. So they're going to weigh these sunk costs, and is it better for me to keep going or just start over? Whereas a lot of times richer people may not. They're going to get their money's worth, whether it's a good decision or not. I thought that was an interesting little piece about the NBA owners and their coaches who are going to play the people who are highly paid just so they can get their money's worth. All right, going back to those 5 items that we talked about at the very beginning, we're going to look at each one in particular now, and we're going to do an example with each one. So, like I had mentioned up front, this deals with having most likely, this doesn't always the case, but most likely it's the case where you have a big name company, a brand name. And again, I'll use, let's use maybe Heinz ketchup. Should Heinz ketchup continue to make more ketchup, but just bottle it and label it as a Kroger brand instead of selling it as a Heinz? Heinz is going to sell it at their normal price, but the Walmart brand isn't going to want to buy it at that price, because not only are they going to sell it cheaper because it's a knockoff, or it's assumed to be a knockoff, are they going to they're going to have to sell it cheaper, so therefore they're going to want to buy it at an even lower rate. All right, so let's look at this example. Some things that we have to consider before a company like Heinz ketchup would even consider making a knockoff brand. One of the things is the factory working at 100%? If they are, then if they're going to accept more orders, they're going to have more fixed cost added in. Because if they're already at 100%, they're going to have a bigger factory, more people working, and probably more machines. So that's going to increase their fixed costs. Not the people part necessarily, depending on who it is. And also, they have to figure in, well, how much will this affect my my current selling price? If the Walmart brand is going to sell it for half of what I do, that could really put a damper on what I think I should be bringing in for this product. So we've got to look at that in the standpoint that there's more competition out there. I'm allowing more competition to sell it at a cheaper price. Are my customers loyal enough that they'll continue to pay my price because they like my brand name? So when you're looking at it simply from a cost perspective, what we're going to look at, especially because of the fixed cost issue, and if we decide that fixed costs aren't going to change, are not going to change fixed costs, all we need to do is compare what is the special price that Walmart or Kroger brand is offering us, and is that more than our variable costs? I don't want to factor in the fixed costs because the fixed costs are already there. They're going to be there whether I sell the extra stuff or not. So all I want to do is compare our variable cost to the sale price. Let's look at this example. So Serta sells 500 currently pillows for 50 bucks. Their cost to make those pillows are $32. So they're making $18 per pillow. And then you have to have the cost broke down in order to know if we can sell it at a reduced price to maybe some knockoff brand. So our variable costs are 22 and fixed costs are 10, which gets us up to that $32 mark. Company is currently operating well below 100%. So the company has a special offer. They have an offer, whether this be from a competitor or simply just somebody wanting to buy a whole bunch of items and they're wanting to get a discount. When you buy in bulk, that usually happens. Should a company accept an offer of 75 units at $30? Now note that 30 bucks is definitely less than my costs up front. So just from the onset, it looks like I'm going to be losing money. There's no way I'd want to do this. I'm bringing in 30, but my total costs are 32. That's a negative $2 profit on every single item I make. That's silly. However, remember up here, we need to look at and focus on just the variable costs. So just the $22. This 10 bucks per item is going to be here whether I make those extra pillows or not. So I simply want to say, okay, if I'm going to sell it at 30 for this special price to this, whatever it is, a big company wanting to buy in bulk or simply a knockoff brand, it only costs me 22 in variable costs. I'm making money because those fixed costs, those are still on for our main products that we buy. And then let's look at this laid out in more detail. Here is the comparison now. I'm going to make this a little bigger so we can see. If I made 500 units, at 50 bucks each, this is where I got the 25,000 from. And this is if we have no changes and I just decided not to do it, whatever the extra pillows. And then if I took $22 in variable cost times the 50, that's where I got the 11,000. And then of course the 5,000 are from the $10 times the 50. So I have 5,000 in fixed costs, whether I make the special stuff or not. So when you go through and take your sales minus your two costs here to add up to 16,000, we have a $9,000 net income. Now, if I decide to accept that special offer, in addition to the 25,000, assuming my current sales won't change. Now that could be a big assumption, but I'm going to assume that, yep, current sales don't change. I'm going to sell an additional 75 items at 30 bucks a piece. So what that comes out to be is an extra $2,250 if you do the math there. So an extra $2,250 added on to my special offer. Now we do have to add in an extra $22 per item, so another 75 items at 22 bucks a piece. So when you do that math, 75 times 22, you should get $1,650 of additional variable costs that need to be added in. And then finally, our fixed costs, we have decided that those aren't going to change. So now I can do our little bit of math here on the income statement and find out that our new net income is now $9,600. By accepting that special offer, I have increased my net income by $600. And you could have done that real fast and simply said, okay, I'm selling them for 30. They cost me 22 in variable costs. So that's $8 that I'm making. If you took 8 times 75, you should get $600. So quick glance, like I just said, if fixed costs will not change, we want to compare the sale price to our current variable cost. All right, let's move on to our second type of decision that we would want to do in our company. Make or buy. Do I want to make my product further or buy it and outsource it? If we have the extra room in our factory, we have the extra manpower available, we may want to look into actually making a product instead of buying it elsewhere. Perhaps we'll cut down on costs. Well, we need to do some comparisons. We definitely would want to buy the product. We should buy from an outsider if another company can make it cheaper than us. And there's a good chance that they could. They have very special equipment, very high-tech trained people that can do things a lot quicker than I can because I'm not as good at it. Think of it even in an accounting firm. Should a painting company do their own books? Well, to do their own books, they're going to waste time. They can't do painting at that time. Plus, it may take them twice as long to do the same calculations that I could do as the accountant. So they're going to waste more time. They have to figure out how much money are they losing by taking time to do their books and not being out painting, doing their actual job, compared to how much cost would I charge to do it in half the time that they would take. All right, let's look at an example. And again, we're going to be looking at fixed costs. Fixed costs are going to be a big thing, a big theme as we continue through here. We have been buying items for $100 each. Our company is below 100%, so we could make our items potentially as long as it doesn't take us over that 100. And with no major increase expected. So that basically means we don't expect to increase the volume of our current product, and we still expect to be at this 80% level of fulfillment. So we're okay. We have the room. And the company is considering making 300 of these units that we are normally buying at $100 each. We've gone through and done the calculation of how much one unit would cost out of those 300. So to buy the raw materials, to put it together, some of the various overhead items, and then our fixed overhead items, I've got those to come out to be $115 it takes to me to make it. You think, okay, 115 compared to 100 to buy it, it makes sense for me to go ahead and buy it. But that's not quite the case. The fixed costs come into play. Those fixed costs are going to be there regardless. So when I'm making the decision, should I make or buy, I do not want to factor in the fixed costs. These would be considered a sunk cost. Those costs are going to be there regardless. I have the extra capacity that I can just continue to make more stuff. So I don't want to worry about that fixed cost. That's still going to be absorbed by our major primary product. So if we only consider our variable costs, the 30, 30, and 20, that only comes up to $80 that it cost me to make this item. So therefore, I am saving money. I'm saving $20 over 300 items. So I'm saving $6,000. So it is most likely going to be the best bet for this company to go ahead and make the items. And I went ahead and did this incremental analysis. This is what this means when you compare the two options, make or buy. So if I make the items, this is how much I planned on spending. So remember up here, they cost me $30 a piece, and I'm going to make 300 of them. So 300 times 30, I'm going to spend $9,000. $9,000 in labor because that was the same price per item. I go through with all the rest. To make the item, It's going to cost me $34,500 to buy the item. I wouldn't have even had to put this in there, but I did. Like, this one could have been taken out since it's the same. It's considered a sunk cost. It's going to be there regardless of the one I do. So I could have just taken it out and compared just these costs and said this is going to be $24,000. This is going to be $30,000. So that's $6,000 difference. Of course, there are a few non-financial factors we would want to consider. Will this hamper our chances to expand later? Yeah, probably would, if we think we would expand in the near future. Does this stretch us too thin from making and having everybody focus on our main product? Does this stretch us more than what we want to do? All right, let's look at the third example. This one is, do I want to sell my parts on a per piece item and just sell the raw materials, buy them from somebody, do very little with it? Basically, I'm just the middleman. Buy them from the manufacturer, I'm the retail store, and then I just resell them and do very little extra work to the product and just sell them at a small markup. Or do I want to take the time and energy to assemble the product? Is there a demand, and is it feasible that I can ship the assembled product to my customers, and would I make more money that way? So here's my little example of selling the parts or selling the assembled units. Say I buy a whole bunch of parts, and maybe it's just actual raw materials. I have 500 pounds of whatever it is, and I can sell them for 50 cents a pound. Or if I take all of those pounds, I can assemble whatever it is and create 100 actual completed units. And those units are going to sell for $5 a piece. However, that extra time and energy that for me to do that cost $1.50 on average in wages and whatever else that I might have needed to make the product. So let's look at our two different revenue issues. I'm going to bring in bare bones $250 when I buy just the parts. Notice I'm not comparing or putting in the cost of goods sold. That cost of goods sold is going to be there regardless if I choose A or B. I'm still going to have to buy those materials with either product. So remember, that's what's considered kind of an irrelevant cost. That's not irrelevant. Or if I assemble the product, these 500 pounds, I can make 500 or 100 units. These should say parts, or I'm going to call these units. 100 units at $5 each, so I'm bringing in 500 bucks. It's going to cost me $1.50 per item. So 150, I'm going to take that away from the 500, and therefore I'm ending up with an income of $350 compared to $250. So therefore, it is more beneficial to me if I go ahead and process our items further. I'm going to make an extra $100. Of course, the capacity needs to be there for us to be able to do that. And the market needs to be willing and to bear that extra cost that other people wouldn't want to take the time and build the product. I compared this then to showing the difference with what a sunk cost is. Again, like a cost of goods sold. If you were making the decision, should I bring in this crude oil and then do I want to make it into kerosene or gasoline? The initial upfront cost to get the item to us, that crude oil, and then to refine it, I'm going to have to do that regardless. So these two costs, if I was looking at a differential report, I wouldn't really want those to be involved in my decision making. Those costs are going to be there regardless if I choose to make kerosene or gas. So I'm going to want to look at just the items here, those costs, and then how much I can sell it for, and then what's the demand. Okay, there's two more here. This is probably my favorite one out of all of them because I think it's the most realistic that you can actually go out and use, and I've actually done this. Classmates that I've talked to have done this. And this is dealing with buying a new car. One of the things I can't emphasize enough, we don't want to base future decisions on our past decisions. Those are sunk costs, like the movie that you just went and paid for, or that dinner that you just paid for. Would you rather continue to eat something you don't like? Same thing here. We're going to focus on relevant costs. So if I buy a new item, like this new car, does it produce better results over time? Yeah, I'm going to have, but the trade-off here is, yeah, I'm going to have some upfront money that I'm spending. Do I really need that upfront money for other things, bills that I need to pay off right now? So there is a trade-off there. I might get a better equipment, but is it so much better that it's worth me spending that upfront money? Let's look at this example. I want to do the difference between keeping my Hummer. I bought it a while ago when they were so cool, but price of gas went way high. Then all of a sudden, and this thing only gets 10 miles to the gallon. Do I want to sell it, trade it in for a new hybrid that gets 50 miles to the gallon? Is the trade-off worth it? Well, as we'll see, it all depends on how much you drive. So how much savings? All right, original price of the Hummer that we bought was $50,000. If I if I do a trade-in, I'm going to get $13,000 for it. So pretty big loss there. Price of the new hybrid, $23,000. I plan on using it for 15,000 miles each year over 4 years. And I'm going to guess that the average cost of gas will be $2.50. So what we want to do is a comparative analysis. We want to compare both total costs and see where we end up. How much am I going to spend over the next 4 years with both items? All right, so I'm going to first just look at the gas costs. I'm going to do that comparison first. So the gas cost for our Hummer over the next 4 years, if I'm driving 15,000 miles a year over 4 years, that's 60,000 miles. 60,000 miles spread, remember that the Hummer gets 10 miles to the gallon. So I'm going to need 6,000 gallons of gas. Each gallon of gas costs $2.50. So I'm going to spend $15,000 in gas. Whereas with the hybrid, same amount of miles. The difference comes in, I need or will utilize a lot less gas. 60,000 miles, when I get 50 miles to the gallon, that's only 1,200 gallons of gas needed. So I'm only spending 3,000 compared to 15,000. So there's a savings right now up front of 12,000 in gas. Is that enough to offset the purchase though? So let's look at our differential. All right, so total costs for the Hummer, we already did this, the 12,000. Plus the proceeds when I sell the Hummer, so I'm going to be getting money, obviously. When I sell the Hummer, I'm going to be getting $13,000. So think of that as like a savings. Less the cost of the hybrid. How much am I going to have to pay up front? I'm going to pay $23,000. So when you do this difference, I'm saving $12,000 and I'm getting an extra $13,000 on top of that when I trade it in. Compared to the initial price of that is $23,000. I'm ended up saving $2,000, which over 4 years is $500 a year. With this type of situation, it is better for me to go ahead and use the hybrid. Now, if I was only driving 5,000 miles a year, then it may not have been worth it. I'd have to go back and do the expense report up here for gas, but it's probably not worth it. If I was driving 25,000, it's definitely worth it if I'm driving 25,000 miles a year. The more miles you drive, the more savings this guy is going to come up with. All right, our final piece here, discontinuing a segment. When we first look at a segment that has a loss, our initial instinct is to decide, well, we probably don't need that segment anymore. We probably need to get rid of it. However, we don't want to jump to that conclusion right away. Now, sometimes that is the case, but a lot of times it isn't, because of fixed costs. Fixed costs play a huge role in lots of our decisions. We've got to look at it when we decide to get rid of a division or decide to think about it. We got to figure out how much fixed costs are going to change if I do get rid of that division. Will fixed costs change by a lot because that division has lots of extra fixed costs? Then I may want to discontinue it. If very little, or if none of the fixed costs will change if I get rid of that division, there's a good chance I'll want to keep that division. What I'm going to want to look at in the case where fixed costs aren't going to change much, if at all, I'm going to want to look at the contribution margin. How much is that product bringing in without any fixed costs to worry about? Because if fixed costs aren't going to change if I get rid of it, whatever that contribution margin is, I'm going to be losing that money. Let's look at an example. So I got the 3 items here, and part C right now is losing money. But I need to decide, is it really losing money? So we're looking to eliminate part C. This is the key piece. Fixed costs will remain unchanged if we eliminate part C. So that means we're still going to use the same equipment. We're still going to need the same building space, but now we don't. Now we're maybe from 100%, we're only utilizing 80 or 75% because we're getting rid of something. Is that going to be good for us in the long run? And the answer is no. I can tell that real quick. When the fixed costs aren't going to change, that means I'm going to have to spread out this $70 over to these guys. These guys are now going to become less profitable because of this extra $70 that part C was absorbing. We're going to be losing $60 of profit that part C brought in. And then, yeah, they will end up losing money because of the fixed costs. But if those fixed costs are still going to be there, that means I'm losing this money, this 60 bucks. Let's see how that works out. If I only go down to part A and B, you're going to note that our top piece didn't change any. Let's look at the contribution margins, 260 and 120. That's the same as up here. That didn't change. But what will change is this. That's 70 bucks. Some of it's going to go here, maybe half, so 35, and then 35 over here to part B. And I don't know how I ended up remembering how I divided it up. But essentially, what we want to look at is this total here isn't going to change. Our fixed costs of $350 are still here at $350. I'm just spreading those $350 out a little differently now, instead of having this extra part C. So now part A, now it's only making $36, when up here it was making $85. In part B, it was making money at $15. Now it's losing money because it has more fixed costs to account for. Therefore, that 60 bucks that I talked about, that's showing up here. Before I was making 90 bucks, now I'm only making 30. So we actually lost money by getting rid of an unprofitable division because it was absorbing a lot of our fixed costs. So my final little piece here is, would your answer change if I had said that, oh, $50 of part C's fixed costs will be eliminated. I can get rid of $50 out of the 70 it currently is absorbing, and I'll only have to give $20 to the other guys. Does that change? And what I want to do is I want to compare this 50 to what the contribution margin is for C. And I'm bringing in 60. I'm only going to be getting rid of 50, so I'm still losing $10. And that shows right here. Before I was making 90, now I'm only making 80. So it's still beneficial if I go ahead and keep C. I'm still making more money. All right, that wraps it up for this week's material on looking at option A, option B type of differential analysis. our final week of our second segment. Next week, we're going to be looking at setting sale prices, and I think that's a pretty neat week as well.